Hey, everybody, let's celebrate. We're coming up to the 4th of July, coming up on Thursday. That means that markets are going to be closed on Thursday and they're going to be dead in the water on Friday. It's going to be like they never opened at all. But hey, what can I say? All right, everybody. And then, of course, this is never closed. It's open 24 hours a day, 7 days a week, 365 days for your edification. All right, let's get into these markets here. We got the dip that I told you about last week. We've got the consolidation that I've been telling you about. And now we're probably going to consolidate again, but with an upward bias. Turns out that the week of the 4th of July is a seasonally bullish period. So look for some, let's call it weak strength this week. We should see us move back up to the old highs. Maybe we'll even penetrate those old highs by a smidge. Now, one thing is, look in the lower right-hand corner and look at the volume. Volume was very heavy on Friday and also earlier in the week, or the previous Friday. So you listen to what I'm saying, because I'm going to come back to this volume again and again in this week's presentation. Dow Jones made a new high. Notice how the selling pressure, the red line, is basically unchanged, but the buying pressure is fading. NASDAQ. Now notice I talked about the high volume in the S&P. We had even higher volume here on the NASDAQ. Now, the NASDAQ didn't break to new highs. I think we're going to surmount the highs we made a little over a week ago. The purple predictor, because of that heavy volume, started to move briskly higher. So I think what's happening is that people are buying the NASDAQ because they think it's going to catch up to the Dow and the S&P 500. Also, IWM is our seasonality indicator. I'm not going to turn it bullish unless we break up above about 159-ish. Don't think we're going to do it this week. We'll probably break above the highs we made a week and a half ago, and then probably stall out at that point. Now, look at this. This is important. We've been talking about it all year long, and here we are. We said that we'd probably come to a peak in July. So you can see we've got about 2 more weeks in this seasonal pattern, and then the market will probably go down a bit. And, well, let's put it this way, just kind of be rocky, up and down, until we get to September. Then look for a more significant down move, and then the fourth quarter should be a normal seasonal bullish pattern. So the easy part of the year is over until we get to November. Now we're going to be choppy, sloppy. Well, the yield curve first broke below 0 in March. We're now coming up into July. Every single time we've seen that negative yield curve for 3 months, there's always been a recession. There's always been a bear market. So this is really, really, really bearish. Now, it's bearish a year down the road. Minimum 6 months. Maximum 18 months. So I usually, in my mind, I think a year. So we need to be focused on this. We don't need to be getting bearish yet. We have to be nervous about the bear side. We don't have to be short. We need to be long right now. Seasonality, everything else is mildly bullish. It's not a big bull market, that's for sure, but things are mildly bullish. So that's the way we need to play it. But we need to be always thinking about, should I get short? Should I hedge? Should I liquidate my portfolio? Now, like I say, we don't really need to be thinking about that, but given the seasonality, maybe we need to start worrying about that in September. That's a little bit early, right? March was when we first got under 0. The shortest lead time ever has been 6 months. That would bring us to September. Now, that would be equaling the shortest. As I say, normally it's about a year. So maybe our scenario is that we go a year out. That would be March of next year. And our seasonality, which is normally bullish until May-ish, kind of peaks out early. That's a possibility. Anyway, the point is monitor it. Don't panic about it. Asset allocation, really nothing happened there at all. Stock market risk indicator, they're starting to want to take more risk, and that's bullish for the market. When people are hunkering down, they go into bonds. They take money out, right? Here's our asset allocation. They're not taking money out of the stock market. They're not taking money out of the bond market. They're doing nothing right now. But when risk is going up, that means that they want to buy riskier stocks. And that's generally bullish for the market. When it reaches an extreme, it can be bad. But at these levels, it's bullish for the stock market. Global shares, pretty much following the U.S. here, but looking a little bit more bullish in a way. Now, bonds, as I said to you before, consolidated, as I predicted for you. Now, we now have a potential ascending triangle formation, or a pennant formation. Volume is declining as we go through the pattern, so that is bullish. So I think what's going to happen is we're going to break to the upside here. It might take towards the end of the week, but I think we're going to break to the upside. Breaking to the upside means lower long-term interest rates. Bond key factors. The most important one is the blue line. That's 10-year treasuries in Germany. But I also want to highlight another change in the market. We talked about gold last week, starting to skyrocket. That's the gold line. The chart itself, the black and white bars, that's the CRB, the Commodity Research Bureau. It's an index of commodity prices, and it started to skyrocket. Now, here's the key. The combination of gold plus commodities is a 6-month leading indicator of bonds. So what that's telling us is that we should expect minimum 3 months, maximum 9 months, rule of thumb 6 months from now, we should start to see interest rates on the long end of the market start to go up. Dollar still drifting lower. Gold, we were long gold. We got out of gold. You should have gotten the notice for our fully paid up members anyway. These are the reasons why you want to be a fully paid up member, so you can get these alerts and you can get these trades. We got long gold and made about $120, $130 an ounce on that trade. I think we're going to consolidate for another week, and then I'm trying to get back long gold. It had gotten too much of a mania there, so I liquidated on the high bar of the chart, which is sweet. Better lucky than smart, as they say. But anyway, and now I think we'll consolidate for a few days and then start to go higher again. So I'm looking for a reason to get long. Gold key indicators. As you can see, the gold key indicators weakened significantly. All of them actually went down during the week, and that's why gold, of course, sold off. So look for consolidation for now. Crude oil, I remain bullish on this, and I've told you this now for a week or two, and I'm looking to actually move back up into the low 60s, maybe mid-60s, let's say 63, 64 as my high. Production cuts remain in place by Saudi Arabia. They remain in place from Russia. Production is increasing in the United States and just hit a new all-time high last week to partially offset the cuts in production by Saudi Arabia and by the Russians. But nonetheless, the Russians and Saudis right now are in control of the oil market. Bitcoin. We're remaining long, nervously long, but long. We're now up around 11,500. We got long around 4,000. So we've almost tripled our money here since getting long. I'm still going to keep my stop loss down around 7,500. Let's call it 74.74, the red line down there. But I'm still a bit bullish here. So I'm hanging long, but I'm nervously long. That kind of explosion usually has more of a retracement, but we got up to almost 14,000. We got down as low as about 10,000. So we actually had a big decline. It's kind of hidden in the chart, but that's actually a pretty big decline. And maybe that's all the retracement we needed to get this bull market back and forth. So I'm going to stay with the long side, but my commitment is weakening. Okay. We're taking the month of July off in terms of our events. And then you can see we're starting back up again in Orlando, Florida. We've also added Las Vegas in September. Our masterclass confirmed in October. Over on the option side, we're 1 week. Here's the cool thing. If you go to Orlando, look at this. Orlando, we have August 3rd and 4th, and 1 week later, the next weekend, we're doing our Option Success School. So a lot of people are signing up for both. They're flying in from Canada, wherever. They're flying into Orlando and then just making the week of it, making it a kind of a, kind of a vacation that is tax deductible, because investment education can be tax deductible. And then Las Vegas, we've added those events as well, those dates. And our master class of options is confirmed for Los Angeles. Now, also notice this. The master class for stocks is October 5th through 7th. That's a Friday, Saturday, Sunday. And then coming up 4 days later, Friday, Saturday, Sunday, is the master class of options. Same thing. People can come for both. And there's only 4 days in between the end of one and the beginning of the other. Once again, think tax deductible vacation. Think about that. All right. And of course, I am more and more concerned. We're getting closer and closer to the upcoming bear market. So please take our course. All right. That's it for me and for you freebies. Of course, all our super cool, fully paid up members. Hang on just a second.